What's up, YouTube? If y'all can hear me, let me know. Let's see. Let's see. I can't see nothing on here. Trying to do this live from my phone. So if anybody that's on the live right now, y'all make sure y'all hit the like button. Hello, Leanne. If you can hear me, please let me know in the chat. I say I'm doing this from my phone, so with StreamYard, this is my first time doing it from my phone on StreamYard. So y'all let me know if you can hear me. Hello, Chris King, Tiffany B. Thank you, Leanne, for letting me know that you can hear me. I appreciate that. Thank you guys for tuning in to my live. It's been a minute since I did a live, and I am trying to test it out on the StreamYard. Welcome to Star Carter Personal Finance channel. On this channel, I talk personal finance, let y'all know what's going on out here in these financial streets. So if you are open to hearing what I got to talk about this evening, please stay tuned. If not, I'll see you in the next video. Thank you, Bridget. How you doing? Thank you all for tuning in. So as you can see in the title, let's talk. We're going to talk $2,000 stimulus checks that our president has thrown out there, as well as the 50-year mortgage. Now, I know this is not no new information, but I've been a little under the weather, so this is my first time talking about it on my channel. So I did not want to not say anything about it. So that's why I'm on here, a little late, but love, what they say, better late than never. One of those type of situations. So again, guys, if you can hear me, y'all hit the thumbs up. Let's get the video pushed out. I really do appreciate it. So, there have been talks about stimulus checks ever since this new administration came, in the door. And I really don't talk politics, but if it has anything to do with personal finance on my channel, then I will say something about it. So I don't get all in the weeds with the politics on my channel. But like I said, if it has anything to do with personal finance where it's gonna affect our money, then yeah, I'm gonna speak on it, okay? Because it has something to do with the economy, and of course, the economy has something to do with our wallets, right? And how much we are spending when it comes to things that we need, everyday goods and all that kind of stuff. So, as far as this $2,000 stimulus check is concerned, if it happens, and the president had posted on Truth Social about he's thinking, not even thinking, he said that he is going to send this money because he's supposed to have made so much money off the tariffs, right, that he's able to bestow upon the American people $2,000 checks each, excluding the high earners. They're not going to get any of this money. So pretty much anybody that's not considered a high earner is supposed to, reap the benefits of these tariffs. That's what he said. So I'm going to briefly take y'all back in time when we were in the C-19 pandemic, right? Back in 2020. And everybody, praised this president because he was the one that supposedly had sent out, I'm putting these in air quotes, supposedly had sent out those stimulus checks then. And so everybody loved him because he was sending out this money, right? But really and truly, Congress is in charge of the purse strings, right? So if Congress didn't approve it, it doesn't matter who was the president at that time. We weren't gonna get any money. Okay, and so we got a stimulus check for him, and I want to say under Joe Biden when he became the president, I want to say we got 2 under him, so we got 3 in all for the C-19 pandemic. Now, of course, interest rates and everything was low, really, really, really smooth sailing around that time. Okay. But when they start putting money that they just printing, out here in the economy, call itself boosting the economy, that's when the prices of all our goods, services, rent payments, all kind of stuff went up. And then eventually the interest rates, how much it cost us to actually borrow money, is going up, right? It had went up. Interest rates on homes had got as low as like 3%, somewhere in that neighborhood, and now it's like almost 7%, depending on the lender, right? And so when you put all that money, into the economy, so-called stimulating the economy, as it says in this name, right? You are going to cause stuff to be even more expensive, right? So this $2,000 check that could possibly or could not possibly come, because they love putting the carrot in our face and just to try to, make us still stay, along with the BS that's going on. If they were to put that carrot in our face, right, and do make that promise come true, and send everybody that's not considered a high income earner, including myself, a check, things are not going to go down, right? Prices of goods is not going to go down, because now you got all this money that's out here, and it's only going to do is make inflation go up even higher. So for the $2,000 that we could get, the long-term effects of that is going to be longer than the benefit of you getting it, because as soon as you spend it, it's gone. But the rising cost of everything else because of it is going to be the byproduct of it. So really and truly, keep the 2,000 and help get the prices back down, help get inflation back down. The promise day one was to get the cost of groceries back down, and that hasn't happened. And so now they're talking about, okay, we're going to roll back the tariffs off beef and bananas and what was the other thing, and coffee, because a lot of the things that us Americans we enjoy, we do not actually grow them or produce them here in America. So they come from other countries. So if you create a problem, then you want to fix the problem. This is something that my husband liked to say, that Trump's like to create a problem that wasn't already there, just so he can so-called fix it. So that's what's going on right now. So if you you had food, everybody saying, okay, the tariffs is a tax on the companies, which it is. That's when it's coming into the United States. It's not a tariff on the exporters, it's a tariff on the people that's getting it in. So if Walmart is getting stuff in from other countries, they pay the tax, right? And then Walmart is not going to eat that cost. They're going to pass it down into our goods and our services that we purchase. So the things that we buy, that extra cost is going to be put into that product, because businesses are not in business to lose money at all. So they're not going to eat the cost of anything that they don't have to eat the cost for. They're going to pass it down to the consumer. And that's not just Walmart and Target. That's all businesses. They're going to pass it down. And so we end up being the ones that's going to actually pay for that. So him taking the call, calling back the tariffs on coffee, bananas and other fruits or whatever. And what was the other thing? Beef, you know what I'm saying? That's his way of so-called, like somebody just put in there, Unity said, to become the savior. That's the way to so-called bring prices down. The way you could have kept prices steady is not had came out the gate with this tariff mess from the get-go. Really, so you create a problem to fix it. It's like you fixing something that wasn't even broke, right? Now, this live is not going to be long, because these are real quick, short points. So next thing, 50-year mortgages. 50-year mortgages. It's like, instead of fixing the real problem, like even with the stimulus check, instead of fixing the real problem, they want to do these stupid so-called solutions, air quotes, solutions that don't help nobody but the people that are already super rich, banks and big corporations, right? Because like I said, we get the check that's going to so-called stimulate the economy. If we all took the $2,000 check and put it in our savings account, in a high yield savings account, and made the banks pay us money on that $2,000, then it would do the opposite of what they wanted to do, right? Because if you go out there and you actually spend it, you're going to make the cost of stuff go up. But if you was to take that same $2,000 and put it in a high yield savings account and allow it to draw interest, then excuse me, and let it draw interest, then guess what? You're not stimulating the economy. You actually saving. You actually going to be making money off that money, right? But most people ain't going to do that. So with the 50-year mortgage, right? So with the 50-year mortgage, it's just like anything else. Y'all done bought cars before. So if you get a car, right? Say it's a $20,000 car. The first thing when you go to a car dealership, and I did accounting for a car dealership for like a little under a year. So if you were to go buy a car, the first thing they're gonna ask you is what kind of payment you looking for. What kind of payment you looking for? Why? Because a lot of times, if they could get the payment where you feel like you can afford the payment, you're gonna ignore the interest. So the longer they can stretch that payment to make it to fit your budget, by if they got to stretch that amount of months that you pay it, that's what they're gonna do. But the longer they stretch it out, the higher your interest is going to be. The higher the interest is going to be, and the more money you're going to pay for that money. That's how that works. But a lot of times we just worried about and concerned about if we can afford the payment, but not the actual interest. How much is that thing going to actually cost us, right? So I'm 40 years old. Most people, well, I'm 47 to be exact. I'm in my 40s. I'm 47 to be exact. So I'm not 40, I'm 47. So if I was to take out a 50-year mortgage right now, that means I'll be 97 years old before I pay that mortgage off. That means that if 50-year mortgages become a thing, that means that a 20-year-old, my son is 24 years old, he just bought his first house. That means that if a 50-year mortgage become a thing at 24 years old, where he is right now, that would make him 74 years old before he pay his house off. You understand how stupid that sounds, right? Like, let's just keep it 100. It's just a way to keep us in debt longer and make the banks be like we renting the house with the so-called mortgage. It's impossible. It's impossible to pay it off because mortgage loans are what they call amortized. I don't know if I'm saying it right. I know what it is, but I can't say it. Y'all put it in the comments. Amortized. meaning that the interest is up front. That's what it means. I can't say it, but I know what it means. It's like it's front loaded interest. So that means that even with a 30-year mortgage right now, y'all, it'll take you like 10 years before you really start seeing the actual principal part of the loan to go down. Most of that, the first 10 years of your mortgage in a 30-year mortgage, you're going to see most of that get ate up to what they call interest. That's front loaded, and a little bit goes to principal, right? Before you even see anything, unless you're making extra payments to the principal outside of what your mortgage, amount is, unless you're making extra payments that going directly to the principal, most of it is going to get ate up by interest, and a little bit is going to go to the principal every month. So think about a 50-year mortgage, right? A 50-year mortgage, because like I said, most of the time they're just trying to make sure that you can afford the payment. So if you could get the payment in your affordability, You're not thinking about how long the thing is, as long as you can afford to make that payment. Now think about making a mortgage payment for 50 years, right? And it's probably going to take 20 years before you even start putting a dent in the principal. Let that sink in. 20 years. You're being paid on a house 20 years before you even start even before you start seeing the principal part even start to even dwindle down. You're going to be done paid for the house, the original cost of the house. You're being paid for the original cost of the house in the first 20 years, but all of that would be done gone directly to interest. So this is another terrible idea. It's like, why don't you make the homes and keep the 30-year mortgages, but make the houses that's already out here affordable? Stop trying to print money out of thin air, causing inflation to go up, which is going to cause the Fed to not bring the interest rates down. So stop doing those things and make things affordable. How about making things more affordable? Instead of fixing the real problem, that the affordability of the houses now, and a lot of people like my son, which are Gen X's. No, is that right? Gen X is Gen Z. I think I'm an X. He is Z. Y'all let me know in the comments. But instead of doing that, right? Why don't you make things affordable now? Why, instead of trying to give us $2,000 stimulus checks, why don't you bring down the cost of the goods? Or most of the time when prices go up, they're not going to come back down. So why don't you make it be a cap at where things are right now? Make sure that the price of groceries and stuff that everyday Americans need don't go up even higher. Leave it where it is, because we know 9 times out of 10 they're not going to make it lower. They're not going to make the price that, okay, the price was this now. It's not going to, they're not going to like slash it to $1 cheaper. If it do go down lower, it might be a quarter or something like that. It's not going to be no big astronomical amount that you can really see it. It's just like when they increase prices over time. But like if you shop like me, I always do most of my shopping at my Walmart, which is like a Walmart superstore. I mean, not superstore, supermarket. And I shop there so much that I notice when the prices go up, because I tend to buy the same things all the time. So if it go up by 25 cents or even a dime, I'm going to notice it because I buy it all the time. So if you're a shopper like me that kind of has the same shopping habits, then you really notice it. But most people don't notice when prices go up, because they go up little bit by little bit till the next thing you know it's at $1. But it's not going to come back down, So let's put a cap on where we already at. Don't put no more extra money into the economy that we don't need. And then too, also, we don't need 50-year mortgages. We need for you to make the housing market back affordable so that people have an opportunity to be able to buy their first home, to be able to do that. We don't need all that. And then another thing too, where they was talking about doing away with the credit score, for purchasing a home. That's a bad idea as well. You want to know why? Because the credit score actually helps you have a range of an interest rate that you could be in, because you have a good credit score. If you have no credit score, then they can give you the highest interest rate, because there's nothing to base it off of. It's like, I work in banking. So when I worked at a credit union, I work in a small bank now, a small town bank. But when I worked in a credit union, we used to have tiers. So if you was in the 750 to 850, they consider that A credit. That means you got the best interest rate, right? From 750 to 850, you got the best interest rate. From 749 to 700, you got what they call a B interest rate. Once you drop below $700 to $699 to I think $699 to like $660, you got what they call a C rate. And then like $659 to like a $600, you got like a D rate. And anything under $600, you got the worst rate it was, right? So depending on what you were buying, of course, if you're in the 750 to 850 range, you're gonna get the best interest rate. You're gonna get the lowest interest rate. And then, like I said, you go down those different tiers. Now, every institution is different. So the numbers I just spat out there, that's not like hard set. But just giving you an idea, A, B, C, D, E credit, right? So if they don't have any credit score, and say you've always paid your accounts on time, you've always been good with your credit cards, you always paid your personal loans, your student loans, excuse me, your lines of credit, everything on time. You've never had a late payment. You never had collections. You never had any judgments, any bankruptcies, any of those things that can tear your credit score up. And all of a sudden now they can base your loan off of nothing. Then that means they could give you any interest rate they want to give you. So that's not a good idea. It's not. I know a lot of people that are like, yeah, you need to get rid of the FICO scores, monopoly and all that. No, it's not, because really and truly, Vantage score been out since 2006. If the banks wanted to use the Vantage score, they could have by now. But it's just like anything else. It costs. It costs them to change their lending policy. So if they've been using the FICO score since FICO been a thing, then they're going to continue to use it. It's not like with our phones and our tablets and stuff like that, where you get an update. If an update comes out, you just, download the update on your phone or on your computer or whatever. It's not the same. What we consider an update on our phone is an upgrade to them. So they have to pay for the upgrade. I don't know if y'all remember, depends on if you're an old head like me, where, you used to could buy Microsoft Word and Excel and PowerPoint, they had the different things, and you could buy the upgrade to the, like if you were using, Microsoft Word 2000, you could buy the upgrade to the 2001, or, you know what I'm saying? You buy the upgrade. So it's not like an update. An update is where you automatically get whatever they released out. So it's just like with the FICO scores. Those are templates that whenever you go to the next one, that's why so many of them use FICO 8 when there's a FICO 10 and 10T out right now. But they're not using that. They're using the FICO 8. But there's a FICO 9. There's a FICO, like I said, there's a FICO 10 and 10T. So they'll let you know. And then our mortgages is FICO 2, 4, and 5. So why are they not using the more update to there? Because like I said, it costs. And when you got as a financial institution, and when you got your lending rules for your financial institution that is linked in to that model, FICO 8 or whatever, FICO 2, 3, and 5, 2, 4, and 5 for mortgages, they're not going to redo it. They're not. Like I said, Vantage's been around since 2006. So Vantage been in existence for 20 years almost, right? And like I said, they're not going to flip. They don't have an incentive to flip. They don't have an incentive to go to the Vantage score. So doing away with the score altogether is not a good thing. Because like I said, then they can charge you whatever. So like I said, the ones that don't have good credit, and their credit is probably keeping them from getting a loan, or may keep them from getting a home loan, they're going to look at it as a win. They be like, darn, I ain't got to worry about no credit score no more. So I can finally get that thing. And they're not looking at my past history. They're not looking, not going to say they ain't going to look at none of your history. They're just, like I said, the credit score is going to go away. So not to say that they're not going to look at your credit report. They're going to still look at your credit report to make sure you ain't out here, not paying people. But there's not a cap on how much they can charge you on the interest based on how you've paid people in the past. So that's why I said that score, you want that score. You really do. Because like me, I've never had a late payment, thank the Lord. I've never had to file bankruptcy. I've never had anything like a credit card or anything like that to go in collection. So my credit score right now, I'm pushing like 800s on all of them. So I would be very upset if they were to get rid of that, because now I could pay, 13% interest on a mortgage. Yeah, that's possible. That's possible when there's no score, where there's no like boundaries on how they can, like, tack their interest on, where the interest rates even start, you know, based on your credit score. So like I said, some of these things that are out here right now are a good thing. And I would encourage you that if you are a person that is in favor of them getting rid of the credit score, you have to ask yourself, well, why are you in favor of it? Is it because your credit is not in the best shape right now? Then you need to work on that. Work on that by getting negative items deleted, doing goodwill letters, making sure you validate in your accounts, you know. Also, if you have been late, start now making sure that you're making payments on time. So why were you late? Were you late because of a lack of income or from a loss of income? Make sure that you're always in communications with the people who you have credit with. So if you are going to have to be late because you are missing a check or things like that, like the government shutdown, stuff like that, you making sure people know what's going on with your finances so they can help you, because there are programs for hardships and stuff like that. A lot of the banks is not going to advertise it, credit card companies as well, but there are things like that in place. And if you don't ask, you won't know. All right. So it's one of those things where when you are about to, hit a financial wall, you get on the phone and you let them know what's going on. You don't just let it happen. Right. And because there are things that's out there that can help you. So, and another thing that I would say too is, in this economic times that we're in, people need to be prioritizing saving more than consuming more, right? So the more we spend, especially with the holidays coming up right now, the more things will continue to go up, because we're showing the economy that we have the money. We need to really start only spending on the things that we need, the necessities that we need to actually, get along in the society right now. I told my husband, I don't know if it was day or yesterday, that I'm canceling Kwanzaa. We do Kwanzaa, we do Kwanzaa gifts. I'm canceling this year, because it's nothing that I need, it's nothing that he needs, it's nothing that my son needs, it's nothing that nobody that we exchange gifts with need. You notice what I said? Need. You know, we bad about stuff that we really need. We go ahead and get it then. We're not waiting on no holiday to get it, right? And so I say, this year I'm not doing it. I'm really not doing it. I'm going to save as much as possible, putting back what I'm not going to be out here shopping for, unnecessarily. So that's something that I encourage you all to do as well. Save as much as you can. Get yourself a high yield savings account, whether it's with a online bank like Discover, American Express, I think, is it Goldman Sachs? Might be, I think with Goldman Sachs it's called Marcus, but do your research. There's a lot of great high yield savings accounts. A lot of you all that are not new to my channel, y'all are used to me talking about Navy Fed. Navy Fed has a very great, they don't have a high yield savings account, but they do have great easy start certificates, where you can put small increments into the Easy Start certificate every time you get paid through your payroll, right? Um, and I think their special Easy Start certificate at the time of this video may be paying over 4%, and you lock it in for 12 months, right? So you got to commit to 12 months, because a CD is different than a high yield savings account. A CD has an actual maturity date, and you can't take the money out without being penalized. A high yield savings account, you can take money out as you need to, right? So without being penalized. So if you do it the CD CD route, you got to make sure that that is something that you can do long term. So don't put more money in it than you know you can't afford to leave in it, basically, because you do not want to pay a fee if you need to withdraw that money out before the maturity date of the CD. So again, think about these things. I think right now, going back before I get off this live, I think that the administration is counting on us not really using our critical thinking skills when it comes down to the economy. We got to do more economy talks, and how all this free money being printed and all that kind of stuff, and stupid things like 50-year mortgages is not going to help us. It's going to hurt us in the long run. It's going to hurt us, and it's just helping you be in debt longer. I encourage you that if you are looking at this video, to go on your Google, or if you use AI like ChatGPT, and just put the numbers in. I tell you guys all the time that people lie, but numbers don't. Yeah, you could pay down debt. Like Kathy Wilson said, what about using to pay down debt? Yes, do that. That's a good way to use it. If you're going to save it or you're going to pay down debt. If you get a stimulus, $2,000 stimulus check, yeah, pay down debt with it. Absolutely. But I wouldn't take it out here to cause the goods and services to go up even higher than what it already is. I wouldn't use it for that. And I just lost my train of thought. Excuse me. So again, I would tell people now that instead of people looking at these things as economic benefits, to really and truly look at things for what they really are. It's a way to not do the right things when you can, like really making sure these prices go down, not giving us more money. If you want to give us more money, give us more money in our paychecks every time, instead of giving the tax breaks to the most wealthiest people. Why are you not giving the tax breaks to the working class people? That's who need the tax breaks, not the people that already have the money. We need tax breaks. So how about that? How about making housing more affordable? Making these corporations stop buying up all the houses and all the apartment complexes, and then jacking up the rent, calling them luxury apartments, right? Stopping all that kind of stuff, where you making it harder for people to be able to just pay rent, where rent is costing more out of everybody's paycheck that pay rent. And people that want to buy a home, the home prices are so expensive that they can't, or if they do get approved, the interest rates is pricing them out. So we need to work on that instead of extending the loan and so-called making the payment cheaper. I remember what I was talking about, going on Google, or either in your AI chat, and just asking them, just plugging in some numbers. Say you wanted to borrow $300,000 to buy your first home, and put it in with a 50-year mortgage, and at an interest rate of like 6.75, and see what the amortization table would look like. That's the word that I couldn't say earlier. I told you I know how to say it, but if I get tongue-tied easy. So that's what I was saying. So go and do the numbers, because people lie but numbers don't. Go on a calculator, a mortgage calculator, or like I said, if you use AI, you can ask ChatGPT to do it, and ask them to put in $300,000. Say you buy a house for $300,000 with a 6.75 interest rate at 50 years, and say you did put down 20%, down on the mortgage, and see exactly how that table, it will break it down on how much you're going to pay in interest and how much the house costs. And look at that interest number. That will put it in perspective for you very quickly. When you see that the interest it's going to cost you more than the home. And that's usually how it goes anyway. But you're going to see that like double and triple in some cases. You're going to see where you done spent $700,000 in interest and the house didn't cost but $300,000. What? Yeah, that kind of thing. Do the numbers. Do the numbers. So I do appreciate everybody that did join the live with me this afternoon. I do appreciate it. Hope to see you guys again soon. Make sure that you subscribe to the channel, like this video, and I'm going to see you guys in the next one.